Welcome back, everyone, to Stay in Your Lane podcast with Triple T Transport. Today, Bob Costello. The man needs no introduction. Bob's been on with this is probably your fourth time with us, Bob, in the past year.
You're lucky I enjoy it.
I'll go along with that. Beggars can't be choosing. So I would say we've hit what we feel is probably the bottom economically here in the country. Last time we spoke, we talked about fuel prices, fuel availability, winter heating, all of those things were the concern. Now it's where are we going from an economic perspective, yield curve going negative. What does that mean? What do you see? And I'm going to give you the floor.
Yeah, well, it's a pleasure to be here. I'll tell you, I still think the most likely path of the macro economy is for a mild recession, probably the first half of this year. But I'm going to be honest with you, the timing is tricky. I'm not, it could be late first quarter when it starts. It could be move into the second quarter. There are some economists that have it in the second half of the year. It gets a little tricky. I guess and actually, while I think it's unlikely, the so-called soft landing that the Fed's trying to orchestrate, which means, they slow the economy and inflation without causing a recession, that's not completely out of the question, although I think it's a lot less likely. Any recession should be short and shallow, right? I do believe that. But at the end of the day, on the freight market, whether we have a macro recession or not, the freight market's worse, right? And I guess it's because the truck freight and really freight overall market is just moving back to historical averages, trend from 2.5 years of well above average demand growth, right? And so we're going back to, things that come to mind. Consumers are moving back to buying a lot more services. I travel every week for work. Planes are packed, right? They are absolutely packed. Housing's in a recession. Factory output is slowing down. There are some good, things like we're going to get a lot of spending on infrastructure coming our way soon. That's going to help add. Actually, it's probably going to keep the labor market in transportation and trucking tight. But as these things happen, the consumer going back to services, buying less goods, that we bought a ton of goods in 20 and 21, in early 2022, that's all moving away. Housing, again, recession, factory output slowing. So that means that the freight economy is slower than the overall economy, if that makes sense.
Absolutely. What I'm hearing is 2 to 3 quarters, probably see an uptick in fourth quarter.
Listen, we're leading the macro front, so we're on the downside, so we're probably going to lead it on the upside too.
Right.
I didn't mention inventories, right? I think that the inventory cycle, and by the way, everybody's talking about inventories, and it's important, right? I'm not saying they shouldn't be, but I hear a lot of high level stuff, which is great. That's just fine. That inventories are way bloated. I think the true answer there is much more nuanced. Okay, because if you look at data put out by the Census Bureau on inventories relative to sales, what you'll see is in a lot of industries and big picture, whether you're looking at manufacturing and even retail, they don't seem that bloated. But if you start to peel back the retail numbers a little bit, what you find is big box retailers got really bloated in terms of inventories. And that's where the problem is. And that's a huge part of it, especially the truckload market, right? Mm-hmm. So, and that though is coming down again. So in other words, they're working off those inventories, and the timing of that is difficult to say. But I'm going to go with done at this end of the second quarter, which gets to what you just said. That means a second half sort of recovery is likely. I don't think it's going to boom, but I think that we're getting closer and closer to bottom. And we haven't even talked about the supply side, right? I mean, that's
Right.
just the demand side. And so I think that's important. And again, we're going to see a heck of a lot as long as they approve the debt ceiling going up. We're going to see a lot of spending on roads and bridges and other infrastructure, which will also lead to a demand for freight and keep the labor market tight in the trucking industry. So long-winded way of saying the exact timing of that is a little sketchy because I don't know the exact timing of a potential downturn, but I do think the second half of 23 should be better than the first half.
I would agree with that. I think that third quarter is going to be somewhat of a transitional struggle, because I don't know where we're at labor wise for a lot of the manufacturing and things that when they pick up.
Yeah, I do think manufacturing, all that manufacturing is just starting to really slow down if you look at the numbers. And so I don't, for the year this year, I've got manufacturing output down a little less than 1%. That's not a lot. By the way, long-term fundamentals of manufacturing, I think, are good. You've got nearshoring, reshoring, friendshoring, whatever you want to call it. It takes time to do that. I mean, it's a long, it took us 20, 30 years to put manufacturing in Asia and specifically China. It doesn't come back overnight. But I think some of that is real. I think at some point, because it's hard to carve these up nicely in third, fourth quarter and stuff. But somewhere in that second half, you're going to start to see improvement, maybe, and some sectors may be earlier than that, John. I mean, it just depends. And so some freight segments might be a little bit better earlier. But my point is, I think overall, the first half of this year is when things will hit bottom, and then we start to come out again, gradual. I don't want people to think, oh my gosh, let's do a repeat of second half of 2020 and 2021. That's not gonna happen.
No, I don't see the demand being able to push up.
Yeah, I mean, it was unique things. It was, we had to, certainly we didn't travel, and therefore we were like, well, and a lot of people got a bunch of money put in their pockets from the government, and boom, they just started buying stuff, and that's not going to repeat.
What do you see interest rates and inflation wise?
So inflation peaked last summer. It is decelerating, but continues to be well above recent historical numbers, right? I think that deceleration in the growth rate of inflation, the Fed doesn't necessarily target the consumer price index, but I think it's a good one for everybody to look at because we can kind of all relate to it. It's what we spend online and in stores. So we're going to go from a little over 9% year over year growth last summer at the peak. By the end of this year, we're closer to 4.5%. Still well above the Fed's target of 2%, at least their existing target. But with that said, based on recent deceleration, I think that the Fed continues to increase interest rates here in the first quarter. And then I've got them right now. I know the market thinks they're going to reduce interest rates in maybe the second half of the year. I think a likely path is probably holding steady. And where that is for the Fed funds rate to be about 5%. So I think they get that in the first quarter here. And then they just sort of take a wait and see approach, because at the end of the day, while 4.5% CPI growth is a heck of a lot better than 9%, it's still well above their target. And I think they're going to hold steady and see where we are with that.
So you're saying we're going to get another bump and then probably hold and then watch to see, trying to, force us back into that 2 to 3% range.
Yeah, I mean, I think it's going to take, we're not going to get that 2 to 3% range this year in terms of inflation. I think You know what? And this is, I think, an important. I think it could happen in 24 to 25, somewhere in there.
Okay.
But at the end of the day, we had really, really cheap money for a long time, and that's not healthy for an economy either.
Right. So too low, too long. You have interest rates too low for too long. You have the COVID situation, pumping all that back into the economy to try and keep things going, probably for too long. And so it's not, we didn't get here overnight. We're not getting out of it overnight. Is that what you're saying?
Sure, I think that's fair. I think, interest rates were already low going into COVID, and then they felt like they had to drop them more. So I'm not sure the Fed had much of a choice. But we had really low interest rates even before COVID for a while, and I think we're getting back to sort of more sustainable, levels for a longer time. So I think that's that's a good thing.
Yeah, absolutely. Anything that you're hearing in our industry, because you're as close to it as anybody, as far as capacity.
A couple things stand out to me, right? One is we've still had some employment growth on the truckload side. Although that's slowing down, it has happened. So people automatically assume that, capacity is growing. Be careful with that, because when these independent contractors that bought, let's say, really expensive used equipment in 21, first half of 2022, and the spot market falling so much, some of them are getting rid of that equipment, right?
Mm-hmm.
And some of them are becoming employees. And when you do that, you have an increase in employment, but that's not an increase in capacity, right? So I think that's an important thing that people need to watch for and trying to read the tea leaves. And with that said, I do think some capacity is slowly coming out of the industry. It's nothing abrupt. Yes, truck sales are up, but there is still a ton of replacement demand out there. Fleets got way off on their cycles because they couldn't get new trucks. So I don't think that supply is, and in fact, we look at sort of, both company tractors and leased on ICs for truckload carriers. And yes, from the bottom, they're up 4.5%, but they're still off over 7% pre-COVID in terms of their fleet size. So that, I've been talking to a lot of folks about that, but generally here, some similar stuff to what we're talking about here in terms of demand. It's softer, no real peak season. I suspect first quarter here is going to be a little soft and so forth. But there's some folks, I was talking to folks just yesterday, and they were like, we think the second half is going to be better. And so that's what fleets are expecting.
All right. Well, appreciate all the knowledge, your perspective. Appreciate you taking time to sit down with us and share, and for all our viewers. And thank you, and look forward to talking to you again here probably next quarter. We'll see how this plays out together.
All right. Sounds good. No, my pleasure to be here.
Thank you, Bob.
No problem.